sometimes it pays if you're trying to trade an option that has an extremely wide bid. Let me pull one up that does have an extremely wide bid on this. Here's a stock I've been following for a while. Is EDU. It's a New Oriental education and technology company, and what they do is they train kids in China. It's kind of like a private school, a private tutoring company for Chinese children in China, to help them better in school. And of course, the Chinese are very, very aware and concerned about the education of their children. They put a lot of money into, if they have it, they put a lot of money into the education of their children. They feel that's the best way for them to advance. And so this company is taking advantage of that trend in China. And I've been watching this stock for quite a while. It's one of my favorites. The bid and ask on these can be quite large. In this case, let's take a look at the June 80 calls. The bid is $1.70. The asking is $1.85. And even though we're on the weekend, normally the bid and ask price are at least 10 cents apart. So this is maybe $1.75 to $1.85 during market hours. And you could put in an order. Instead of paying $1.85 for that, you could put in an order to buy it at $1.80, which is the mid price, saving yourself 5 cents. Now, on a single lot of this call option, that won't save you a lot of money. But if you were to do larger numbers, the savings could be significant. On a 10-lot order, the savings would be about $50. On a 1-lot order, the savings is $5. And guess what? $5 is still $5. So, if you can get it at the mid price, I would submit it. I mean, if I were to purchase this option, I would always go in the mid price and see if I can get it for $1.80 instead of paying the natural price of $1.85. You can also look at these prices as being either retail prices and wholesale prices. I look at the mid prices as wholesale prices. And the natural price is really the retail price of that option. And if you didn't know anything and you didn't take this training, then you would always pay the natural price or the retail price for those options. But every once in a while, are you going to get the mid price all the time? No. You may not get it even 20% or 30% of the time. But, the times that you do get it, if you get it 20% of the time, it's going to save you a lot of money on your options that you're purchasing over time. So it's always worth trying to get the mid price on any option. Okay, let's move on. We have that's just a very short little example of how a single option is priced and how orders are entered and what they mean and how you profit from them. Remember, if the underlying stock here, in this case EDU, goes up, this option will increase in value. Let's say it goes up $5. It's currently at $75. And if it goes up $5, what will happen to the price of this option? Well, what will happen is that if it goes up $5, we can take a look at, now the stock is at 70 or 85 rather, instead of 75, or no, I'm sorry. It's currently at 75. So it goes up $5, it's currently at $80. Then that $1.85 option will go $5 further into the money, and it will be worth approximately $4.10 because it's $5. Right now, the stock is at 75, and the 75 calls at $4.10. If it moves up $5, then that call will now also be worth $4.10. That call will be now, the 75 call will move up, and it will be worth $7.30. So that's why people buy call options, because if they believe the stock will go up in price, they will profit from it. So why do we do spreads instead of buying single calls then, or single puts? The reason is that our risk is a lot less. For example, if we were to purchase this call option for $1.85, if the stock moves against us and the stock actually moves down instead of moving up, now let's say it moves down by $5. Now what happens to our call option? Well, now it's only worth 70 cents. We've lost $1, almost $1.10, $1.05 of the option price. That's almost 50% of the option price. So normally what we like to do is create what we call spreads. And a simple spread order is simply the purchase of one option. And what we need to do here is, in order for me to show you this, we need to select the advanced order tab from single order to blast all, just so that we can show all of the options that we're purchasing. Here, let me show you what happens if you have it on single order. We can buy that, and then let's say we want to sell this one. Well, it just changed it. We didn't get both of the orders in there. So we need to change this to blast all. And then what we're going to do is we're going to create a very simple vertical spread. A simple vertical spread. Let's say we take the 75 call, we buy that, and in order to protect our investment, we want to sell an option at a strike price just higher than that. And this is called a vertical spread. We're buying one option, we're selling another, and that will protect us, okay, from a downturn in the market. Because what will happen is if the price of this option, if the price of the underlying stock goes up, this option that we purchased, the 75 call in this case, will increase in value greater than the one that we sold, in this case the June 80 call. We sell the June 80 call and we'll make money on the June 80 call if the market goes down, and it will help protect the price that we paid for the 75 call. We'll still lose money on this position, but we won't lose as much as if we had just purchased the 75 call alone. And if the market goes up in the direction we anticipated, then the 75 call will increase in value greater than the money that we've lost on the 80 call that we've sold.